back to the show. It's me, Hugh Sanders here, and we've got Susan-Mallin joining us now, the Associate Portfolio Manager, Vice President, Financial Planning Department, Mallin of Steinberg Wealth. And it's great to have you on the show, Susan. And boy, do we have some questions for you.
I'm ready.
Right?
I think.
He has been waiting all day for this.
I need to be deprogrammed. I keep getting all this conspiracy information about how the whole global economy is on the verge of collapse. But every time I talk to you, I'm reassured. What's Susan, seriously. And you make sense, so let's...
Okay, what are your new theories now?
Okay, the new theories.
I know the last one was Bitcoin.
Well, that Bitcoin.
That he still is with that.
Well,
okay.
Bitcoin's an interesting phenomenon, but we're not going to go there today,
okay.
right? And it
sure,
doesn't, just because you got Bitcoin doesn't mean the economy's going to collapse, right? But
does it have anything to do with Shemitah or Shemitah?
What, the Shemitah? Yeah, this is the
Shemitah?
Shemitah year. I was telling you about that, right? The Shemitah, oh boy. Anyways,
what
that's
is that again?
Is that too long to go into Shemitah?
We're not going to go into that today, but
okay.
Anyway, there's a book out there about it, but we're not.
I think it went in one ear and out the other.
It's like the end of the world thing, right? Like seven-year cycle.
The cycle.
Right, Jonathan Cahn's book.
Okay.
Anyways,
I remember
The Harbinger. Okay.
Yes.
Anyways,
Harbinger
but here we are.
of
This
the
is the
end.
Shemitah year for whatever that. The economy doesn't seem to be doing so bad, although a lot of people are talking about imminent collapse of the stock market. There's people talking about either we're on the verge of a great inflation, perhaps, with the U.S. Debt at $18 trillion, something like that. We've seen a lot of the manufacturing head over to China and that sort of thing. I mean,
And
so
oil is all over the place.
oil is down, gold is down, which is odd. So what's happening? What's going? But what do you see? The last time I was talking, you were talking about corporate. I don't know. What's good? What's good in the economy right now, Susan?
Okay. Well,
Housing's always good. Sorry, you know what? You talk.
okay. It's okay. Well, okay. So you're looking at the global economy, and there's different pockets of growth, and there's pockets of stagnation. Clearly, when we're looking at some of the biggest economies that typically drive the growth in the stock markets, you're looking at Greater Europe, you're looking at the United States, you're looking at Japan, you're looking at China, of course.
And the BRICS now. Now you've got the BRICS.
Well, yeah, you've got the BRICS, but you have to understand a lot of the BRICS, and Canada should be kind of included in a BRIC, by the way.
Okay.
Because Canada is a very small economy compared to the bigger economies in the globe. We're really only like a 2% slice of that pie.
Wow.
Right.
That's very small.
And we're very commodity driven.
Yeah.
Okay.
Hewers of wood, drawers of water.
I'm sorry?
Hewers of wood, drawers of water.
Oh, yes, the rock, paper, trees, whatever.
Rock, paper, scissors.
Yeah, okay. You want to play?
That could be a whole show.
Okay.
I'll referee.
Anyways, going back to the whole economy thing. The economies generally are growing slowly. I mean, you have to think about some of these bigger economies, like the U.S., have been fighting deflation for years, okay, since the financial crisis, right? So there's not a whole lot of inflation headlining.
Which I find unusual because of all that quantitative easing. That's a lot of money injected into the market.
has gone in certain places, right? So it has gone in Canada and in some places in the world, it's gone back into the housing market. It's definitely gone into the stock market, right? Stock market has been great since since 2009, right? It's gone into a lot of private equity, the unicorn companies that you may hear about. That you might like that term.
I do like it. I've never heard it before.
Unicorns. Okay. Yeah. Well, so think Silicon Valley. Think technology startup companies. Private companies, not yet public.
Okay. So these are companies that are new. They got a great idea. They're growing.
They're not necessarily new. They're fairly established. Some have nowhere. I think Uber. You've heard of Uber?
Yes. Who hasn't?
So apparently that company is valued somewhere in the, I think, was it $8 billion? I think
something like that. Yeah.
But it doesn't have any real earnings.
Okay.
Okay. So think about that kind of private company, getting that type of valuation. There's a whole bunch of them out there in Silicon Valley. So if you're thinking about things that are potentially inflated, that could be it. Mm-hmm. But I don't deal in private equity anyways, as you know.
Right.
But I just thought you might like that term, unicorn.
I really like it a lot.
Now you're going to look it up, right?
I know. Okay, so people talking about the U.S. has been battling deflation. Even in Canada, we've seen the government interest rates coming down because they're trying to stimulate the economy. They're trying to keep money cheap so that money will go into circulation, right? That's the reason why we keep interest rates lowered. But some people are saying, how long can you keep doing that? Some people are talking about, of course, one of the benefits of the U.S. economy is that they are the global reserve currency for petroleum, right, for the oil industry. But some people are talking about certain big oil producers or consumers are moving away from the U.S. dollar. And that could undermine the U.S. dollar, could prompt interest rates to rise, especially with that big $18 billion debt hanging over everybody's heads.
Well, look, the currency markets are complicated.
Yeah.
And fairly volatile for the most part. It's very hard to make predictions in currency and interest rates. But if you're looking at long-term trends, if you look at the Japanese market, which had the housing crisis and financial debt crisis, in a sense, well before the U.S. market and European market did. So theirs was in, 1998.
And they're still stagnating from that, right?
They went through a 30-something year bear market. Mm-hmm. They went through 30 years' worth of declining interest rates. Mm-hmm. They went through an awful lot of different political changes at the same time. So their policy, their monetary policy to try to address the deflation kept changing. So everybody kept coming in with a new idea and a new trick.
Right.
And eventually they just did nothing and let it go this way. So when the financial crisis hit the European and North American markets in 2008, they didn't want that Japanese-style deflation. So they were working to stimulate the economies, and yes, you can call it, in basic terms, printing the money, in a sense to, when money is in circulation, you typically are getting spenders.
People have some money and they can spend
exactly.
it. Yeah.
So sure, you keep the interest rates low in that sense, but they can stay low for a long time. I mean, we've had declining interest rates in Canada, when you think about it, since the 1984, 85 was like the peak. When
we crawled out of that
we had an inflationary
post-Keynesian interest rate.
What was his name? Volcker? He burst the inflationary bubble
of the 70s through high interest rates,
in the 1980s. And we've had pretty much declining interest rates since then. Mm-hmm. So now we've been kind of bouncing around the bottom for however many years, the last 10 years, near 2% to almost 0% interest rates. Can they bounce around the bottom like this for many years to come? It's possible, right?
Yeah, well, here's the thing. Okay, so this is
nobody can just say just because we've hit bottom doesn't mean that suddenly we're going to have this opposite effect for the next 30 years. I mean, you can't really predict that sort of thing.
No, but here's my issue with it, and this is sort of maybe a macroeconomic, and I don't know if this is the right conversation for that, but like when Reagan and Thatcher came in, and they decided we're going to take a different. The Keynesians all of a sudden lost favor, and a new group of economists came in, and they said we can kill inflation with interest rates. We can raise our interest rates. We can kill inflation. That's what they did.
And they caused a recession.
And they caused a huge recession. And
it's
you're
like
right.
A reset.
We have been. It was like a whole new approach to economics since the Second World War. It was a new way of doing things economically in terms of economic
I think Reagan
management.
was very big on the whole supply side economics type of thing, where he was stimulate the companies.
Trickle down.
And the trickle down came from him.
Yeah, trickle down. And arguably it worked, in the sense that inflation in the sense that they solved the inflation problem.
Okay.
And you can see how well that worked by counting the number of homeless people on the streets of Toronto, because we didn't have that problem before. So you solved the inflation problem, but
Are you sure?
Huh?
Are you sure?
Yeah. Well, yeah, I am.
No.
No, I'm just saying that there was a big displacement. Yeah, you solved inflation, but you got a lot of systemic unemployment, and you killed a lot of. It was a.
So did you really solve the problem then?
Well, you solved one problem, but you arguably got another. And here's my concern: is that I think that this approach, the one tool to deal with inflation, interest rates, since 1980, they might be running out of options. If we go into a deflation, and we are, you're saying, still struggling with that a little bit, then what do? You can't really have negative interest rates. That's kind of crazy.
Sure you can.
In a way. Maybe in the short run, but I don't know if you can do that in the long run. And
well,
I'm just thinking that maybe if there's a huge crisis, another crisis, and some people say that the 2008 crisis was a paced over fixed job with quantitative easing, that you can't build an economy simply by printing more money, is a criticism.
But the thing about the printing the money issue is there always has to be somebody in the economy who's spending.
Yeah.
So whether it's corporate driven, consumer driven, or government driven. So with all this money printing, you could say that that's government driven spending to stimulate the economy. Who's got all the money right now?
I don't know.
Corporations.
Okay.
Their balance sheets typically have never looked better.
Okay. See, that's what I like to hear.
Okay.
That's sounding good.
So
very
not every company, of course. You're always going to have the bad apples, but if there's a lot of companies that have a lot of cash on their books, they have no debt.
Mm-hmm.
Right. So who's going to be the next logical spender? Probably the corporations.
And they're going to invest in.
They're going to invest
growth.
in their own infrastructure, their technology, in hiring people, developing more markets globally for customers, which might create a little bit of wage inflation. And with a little bit of wage inflation, will create more, the trickle-down part where you have the consumers feeling more confident and spending money. And, of course, so like Janet Yellen came out today and she did her speech and she basically was saying that the U.S. economy is hitting pretty close to their 2% inflation target. And so yes, it's very possible that they will start raising interest rates in the U.S. in 2016. Potentially what they're predicting, people predict, that's what we do in our industry, but doesn't necessarily mean it's always right, but about a 1.25% increase over a 1.5 year period.
That's not bad.
Yeah.
We can handle that.
Well, hopefully we can handle that, but you have to think when you're almost at zero and you go up a 1/4 point, there's a 25% increase.
That's yeah.
So you know what I'm saying? It's like.
But I'm thinking in terms of people's mortgages because we've seen that house prices go up, and we that hasn't burst that bubble. Maybe it's not a bubble, but we haven't seen house prices decline in Canada. But the thing is, people are like mortgaged to the hilt. If interest rates do rise, that's what that recession in the early 80s was all about.
Yeah, I don't necessarily buy into that completely. I feel more or less that in Canada, you can't just stick the keys in the mailbox and walk away from your house without pretty much declaring bankruptcy on all your assets, right? It's not like the U.S. where your mortgage was attached to your home only. I think it was called a non-recourse mortgage.
Jingle mail.
Something like that, yeah. But, okay, typically people can't pay their mortgages when they lose their jobs.
Yeah.
Or if they're not getting wage increases to go up with inflation.
Yeah.
Right.
The lending criteria in Canada for the major banks, it's not like what it was like in the U.S. There are B lenders for sure in Canada, but I think the lending criteria is very strict. It's based on income, and if you have a fixed rate mortgage, which a lot of people do, you're not going to be subject immediately to the interest rate fluctuations. if you get a variable rate mortgage, typically in Canada, when they approve you for that mortgage, they usually do an income test based on what the 5-year fixed rate is, which is usually higher than so just because your rate might be 1%, you probably have to qualify for that mortgage based on 3%.
So that's
through
a
your
safety.
income. So there's a bit of a, I think it's a little,
More.
I mean, it's like if my house lost value 25% tomorrow,
Yeah.
what am I going to do? Nothing. I'm still going to live there. I'm still going to go on with my life.
Yeah.
Just because the house loses value doesn't necessarily mean people are going to walk away from it.
Yeah.
Okay.
You still need food, you still need shelter.
And also the interest rates aren't going to jump up like
They're not?
really high
Okay.
immediately. There's nothing that in the economy right now that would support that.
So you're in the industry. Have you heard? There's a lot of these guys out there that are preaching doom and gloom. Like, do you pay any? I mean, are you aware of any of those guys?
Oh, I've always been aware of things like that because
Yeah.
it's always around. It always has been. It's Y2K
Right.
in some sense,
Yeah.
right? Y2K was probably. I mean, I remember people were thinking literally that the next day that they would wake up and their bank accounts would be dry and that the bank would have lost all your identity. And
It was weird.
so and nothing happened.
So the sky's not falling.
Yeah, my alarm clock went off. Yeah.
Yeah.
Until the sky falls.
Until the sky falls.
Yeah.
Right?
So no, there's always going to be doom and gloom, and eventually somebody who's predicting a bear market is going to be right.
At some point, yeah. And then
It
everybody
always
goes,
works that
He
way.
was right. He was right.
Yeah.
Chicken Little was right.
Which, in a way, though, I mean, I think that it's healthy to have that as long as you see it for what it is, because it helps us. I think that it's always good to have the other side, even if it does seem like doom and gloom. It just helps. I think to even out. It's always important to see every side, good, bad, and everything in between. So I think they serve a purpose because you said they're always there and they're always going to be there.
Yeah,
It's a
you
fact
always
of
need
life,
to get
right?
that reality check every now and again because you can get overconfident in the market just the same way as you can get pessimistic.
Exactly.
Right.
Exactly.
Okay, so what you're saying is that corporate balance sheets are strong. So
For the most part.
So companies are, for the most part, they're in a great position to weather any storm that comes along, right?
Well, here's what I think.
Okay.
Okay, and I'm not in this background, and this is like foreign to me to some degree, but because this is not my thing. But I think that the U.S. is completely bankrupt, and it's all just a facade. They're basically on fumes, and I really think the superpower is China. And it's just a matter of time. I think the U.S. it's all a facade.
Yeah, sometimes we have to decouple.
And maybe I'm way off on that.
Well, I think sometimes you have to decouple what's really kind of going on as far as the government debt. It goes back to they were the spenders to stimulate the economy and not create this like much deeper recession and deflationary scenario that could have happened. But if you think that there's a pool of money sitting here on this table, and I have it, all of it.
Okay.
And I'm going to give you some, I'll give you some, you're going to give it back to me, it's just going to go around the table.
Okay.
Right?
Okay.
It's not disappearing.
It's a cycling.
It's just recycling.
Okay.
So the money, there's a lot of money on these corporate balance sheets, and when they unleash that, it will create economic growth. But we have to decouple sometimes what's going on in the economy and what's going on in the government and politics. And a lot of that is headline noise that hits the stock market, because what I'm dealing in is the stock market.
But isn't that what the stock market is really based on?
The stock market should be based on, a company should, all things being perfect, should be priced on that stock market based on what that company is valued at. If you were to take it apart and sell it, how much would you get for it?
Now, how could you do that with the unicorn companies? So,
well,
they're
not publicly traded, so
Okay.
they're privately valued, and whether or not the valuation on those are
accurate.
Yeah.
Okay.
But anyways, the publicly traded companies, if all things being perfect and equal, if you were to tear apart that company, you should have a value for it.
Okay.
The issue with the stock market is that the stock market doesn't always get that right. Okay, sometimes what the stock market, people are, it can be filled with a bunch of emotions, panic, overconfidence.
Irrational exuberance.
Exactly. Deoxyribonucleic acid. I don't know. But yeah, so the market will make a mistake. Sometimes they'll underprice a stock.
Okay.
And sometimes they'll overprice the stock, many stocks. And when the collective market realizes that the stock market is overvalued. And how they value it typically is, it's not necessarily what the company is worth today, but they're valuing how much earnings that company can make in the future. Okay, how far out in the future, it depends. It goes back and forth. Yeah.
What about volatility? People keep talking about that these stock markets are more and more volatile all the time. I mean, that's got to be a challenge.
I think they've always been volatile. I think people just see it more because it's everywhere. I mean, you've got the 24-hour news channels, you've got the internet, everybody.
And everybody can be a trader too now, right?
Yeah, I mean, I think it's just more visible to the eye, but it's always been there.
Well, it's probably maybe some of this automatic, like machine, when the computer is making the trades. So everything's speeded up, right?
And constant.
No, whereas you had in the old days, you had to phone somebody, and before that, you didn't even have phones, right? Now you got computers making decisions for you.
Yeah, well, that's true.
Right?
There's probably more volume with more baskets going on when mutual funds came on board and exchange traded funds now.
Yeah. Can we talk about derivatives?
No.
Okay. I don't even know what a derivative is anyway. But I wonder.
You made it sound like you did.
You don't want to talk about them?
I don't do derivatives typically, but I mean, you could say derivatives, there's a whole lot of derivatives really, but a common one would be something like hedging currency. Mm-hmm. You would use a derivative type of thing to do that.
Yeah, I don't even know what that is.
Yeah.
It's complicated.
It's trying to make things currency neutral.
Yeah.
Okay.
Yeah, okay. What else should we talk about?
Well, what do you need to be deprogrammed from?
Well, I just...
And now the therapy session begins.
Because it's the Shemitah year, I'm concerned that we're going to have some kind of great big... calamity in the economy.
Well, if there is something, there's nothing that I can see, or most people can see, that would do this unless there would be some kind of surprise, something unknown. In which case, no one can really predict that now.
Right. Well, and that could be something like you're asking. What it could be all this terrorism stuff, right? That just freaks people out, or something like that.
Well,
or the
wars and things like that have been going on for a long time, and the market still survives.
But the oil is so unpredictable. What is up with that?
Look, oil is first. There's two things with oil. Well, there's many things with oil, but let's just talk about. In general, oil has always been typically a supply-demand. It's a commodity.
Okay.
Okay. You had a lot of companies, and plus technology improved when it came to different types of energy liquids that you could get out of the ground with the fracking and everything like that you've heard. So lots of supply coming up. Technology improved to make it cheaper for companies to get the more expensive oil out of the ground, aka oil sands.
Okay.
You get a lot of supply. You had a lot of demand, global demand with China, but when the demand starts to come down a little bit, the oil just goes into storage, the excess oil. Okay. And you've only got so much storage space.
Okay.
So if you're looking at a supply-demand situation and you start running out of storage space, you're going to start getting your productions are going to get cut.
Yes.
And it's difficult to know exactly what's going on because some of the smaller companies that typically don't have the big, large balance sheets like we were talking about before, that have a harder time weathering the storm through price fluctuations on the oil, increase production as the price falls.
So they get their cash flow.
Volume.
Yeah.
They need the volume. And that sort of exacerbates the problem.
Yeah.
So, typically in the U.S. in the past recessions, demand really just stayed the same. It didn't really fall very much, but the last recession it actually did. But the one thing that's good about this, it's not necessarily great for Canada in a sense.
Right.
Because we're commodity-based, oil-based.
Well, we lose jobs over it.
Yeah.
But in the U.S., a low oil price will translate to maybe lower gasoline prices, which is actually an economic stimulus for them.
Because that's going to free up money for other things, right?
Yeah.
So
Buying things.
isn't that always the way, though? You know, what's good for one side is not good for another side, and vice versa. Then it switches, and isn't that what just
It's like that's
part of the whole
cycle thing.
recycling
It's like-
thing? Yeah.
Yeah.
Okay.
It's like Canada. It you know, it goes between teeter-totters between what's good for Alberta and what's good for Ontario.
Yeah.
Or because Alberta is the oil-producing province, so when oil prices are high, Alberta's doing well, and Ontario's hurting because it's expensive to do manufacturing. And when oil prices drop, the opposite happens, right? It stimulates manufacturing in Ontario and Quebec, and
And you know, and even still, it benefits some companies in Fort McMurray to have all of this happen right now.
really,
Yes.
why?
Well, first of all, the labor supply is no longer tight for them. Like it's loosened up.
Oh,
they
yeah.
don't have to pay as much for
Right.
new employees.
Yeah.
So they've been able to cut some of their costs.
Which is bad for Newfoundland.
Yes. Sorry. Right.
Okay.
It's like
Yeah.
I'm just saying, that's what she's saying. Sometimes it benefits one to the expense of someone else, but you know, prices of the houses have gone down a little
Yeah.
bit. Rents probably come down.
Yeah.
The smaller companies are shutting down their production, or you know, their valuations are going down. So you have the companies with the really healthy balance sheets picking up good companies at cheap prices. So there can still be some activity going on that's beneficial to some and not so much to others.
Yeah. Yeah.
Well, you know, and same thing with the Canadian dollar. With you know, I remember not too long ago when the Canadian dollar was like 99 cents. Wasn't that long ago. And what's it now?
74 maybe.
You know, I remember when it was like 99, 98, and then it just, after all this happened in the last year, it's just been, but, you know, now it's like 74, whatever. But it wasn't that long ago when it was way up.
I know.
Well, that's the thing. Currencies can be volatile. You have to understand
Wow.
the current. There's really 4 major currencies in the world:
Okay.
the U.S. dollar, Japanese yen, the pound, and the euro. Okay, everything else pretty much trades against those major currencies.
Interesting. I did not know that.
Yeah.
Wow.
And
It's like if you wanted to buy, and you don't see this when you go into one of those exchange places and you want to buy, let's say, Australian dollars.
Yeah.
And they just give you an exchange rate. Like the exchange rate actually is your Canadian dollar's crossed against the U.S. dollar first into the Australian. So it can be complicated. It moves extremely quickly, and there are people who make a lot of money trading currencies and lose a lot of money. It's one of those sort of high risky things.
Mm-hmm.
Wow.
Okay, so Susan, so you're the VP of the Financial Planning Department, right?
She's the queen of finance.
Yeah, you're the queen of finance. You're the go-to financial planner in Canada, right?
Except for Quebec.
Why?
Well, I
She
don't
doesn't
know.
speak French.
They have actually. I do.
You do?
She's actually French.
Oh, wow.
I know most of the swear words too. No, I'm just kidding.
Then that would be all of Canada. You're queen of all of Canada.
Quebec has a different regulatory system for financial planners.
So you need special certification in Quebec? Is that what's going on
Yeah,
there?
yeah. They're
Okay.
trying to get that for the rest of Canada too, to make the financial planners more as a recognized profession.
Right.
I mean, it is a recognized profession, but it's hard to get your financial planning designation.
You know what I want to ask you? Because
Yes.
here you are, and you're with Lauren Steinberg, and we got your website up there so people can get in touch with you this way, and I'm presuming maybe you're happy to accept new business down there yourself and Lauren Steinberg Wealth.
Well, we have offices in Toronto
Yeah.
and Montreal,
Yeah.
but we have clients from all over Canada.
Let me tell you because you told me some things about the company that really impressed me in terms of your approach, because usually when people are investing in the stock market with one of these other companies or their financial planner, they're getting a really broad basket of stocks. And your guys' approach really impressed me. Do you want to talk about that? Is that something you can talk about right now?
We're very picky.
Yeah, super picky. Do you want to?
Super picky.
I like the philosophy. Can you just describe it? Because people, I think,
What does super picky mean?
I bought into it. So tell people what.
Okay, we are value investors.
Yeah.
Think Warren Buffett.
Okay.
Okay, Warren Buffett is the kind of investor who will buy a good company at the right price, hopefully, cheaper than what it's actually valued at.
Yeah.
And he doesn't use emotions. It's pure logical thought that if a company can be bought at a value that's cheaper than what it's actually worth, there will be a reversion to the mean where eventually the company will trade at its actual market price, maybe even higher at some point. So that's what we do. We buy good companies, large companies. We wouldn't buy a unicorn company, for example.
That's too bad. I like those unicorns.
Established companies that have a global customer base where the stock is trading typically for less than their cash. And we can find those companies. We actually find a lot of them in Japan.
So you're buying smart.
We buy global companies.
Right.
Like we're global investors, so we're not stuck just in Canada.
Yeah.
We only buy companies when they're trading at below valuations, and then we patiently wait for them to come up. But it's also part of it is the portfolio, the way we construct the portfolio for a client.
Right.
So we hold if we were fully invested, we'd hold about 50 stocks or so. So when you think about that, you're dealing with tiny positions, like 2%
in each company. Yeah.
We're not like a high risk, high conviction sort of portfolio managers where we're going to stick 5 or 10% of a client's money in a company. Because when those portfolios do well, they do really, really well.
But it's
it's more risky because when things don't work out, that's when you can lose a lot of money. And we have pretty much found that historically, you make more money in a longer period of time by not losing money. Mm-hmm. So that's why we go with the value, because typically your downside risk when you buy a company that's trading at a good valuation is less. Mm-hmm. Your upside potential is higher. Mm-hmm. But if you were to buy a company that was fairly valued or even slightly overvalued, and you figure out this valuation by looking at their cash flow and their balance sheets and their earnings potential, their historic earnings, have they been growing their earnings? What's the management like? Mm-hmm. So we try to pin a value on there. But if a stock is trading at fair value, even if we really like the company, we're not going to buy it at that price because we feel that the downside risk is higher than the upside potential.
Not unless they meet your SMART criteria.
So if you could be patient, you can find those companies. But honestly, there's right now in the client portfolios we are still holding about 30% cash still. We have cash that we have not deployed in the market yet.
And that's because you haven't found.
Yes, some people would think that we're making some kind of market call where we think there's a bear market coming or there's a bubble somewhere, and that's not what it is at all. We're looking at the universe of stocks that trade in the world. We don't buy directly in China or Russia. We'll buy stocks that might benefit from the growth in China, but they have to trade in very liquid stock exchanges and in countries that have good rule of law.
And why is that? Because they don't have good rule of law.
You want investor protection when it comes to certain,
And that's not the case with China and Russia.
Yeah.
It's not as transparent.
Some people made the case. I read a book, I forget who wrote it, one of these just recent books, talking about how even with all that growth in China, one of the things you really need to have a stable and strong economy is an excellent legal framework that protects basically people's property and enforces contracts and that sort of thing.
Property rights. When you're a shareholder, you're an owner, really.
Yeah.
Interesting.
So, but the thing I liked about the 50 stocks versus like a really broad portfolio is that when you're getting that broad portfolio, you're just likely to follow the direct way the market goes, right?
Well, that's true. I mean, that is true. Like some people will buy a bunch of exchange traded funds or have 5 or 10 or more mutual funds in their portfolio. When you look at what's inside a mutual fund, sometimes there's 500 different stocks.
Yeah.
If it's a Canadian mutual fund, when you look, I don't even know, like there's 700 stocks in Canada that you might want to look at. Half are probably don't want to buy. The other half are banks and mining companies and oil companies and what did you call it? The paper rocks and trees and scissors. So, but anyways, then you can have all these like global mutual funds, and you end up with, I don't know, like if you were to really dig it out, 10,000, 20,000 different stocks in your portfolio. Mm-hmm. So what you're doing then is you're just mimicking the market volatility.
Whereas you guys, with this approach, with your excellent analysis of the companies, is you're buying smart, right? And that buying smart is something that every one of your customers benefits from, right?
Value investing is probably, it's the hardest type of discipline to have, I find, because you really have to keep your emotions out of it. Mm-hmm. And so we use an investment committee so that everybody keeps everybody accountable. Nobody falls in love with their stock. We have to know when to sell.
It's my grandmother's tomato sauce.
Well, there's a lot of that. There's a lot of various cognitive biases in the market, price anchoring, which is more of a cognitive bias, but then there's emotional bias, which is something like that, fear, greed, overconfidence. And you see that when you look at charts. That's like the stock market emotions. It's like looking at an X-ray of investor emotions.
Yeah, and when you see that big crash we had in August, that was just a really bad day. The stock market was having a bad day.
That's a heart attack. Cardiac arrest.
All right, so what do you think well, no, I'm not going to ask you to prognosticate
Canada always
here.
seems to come out okay, though.
Who?
Canada. We always seem to come out okay. Overall.
In what?
Well, we just
economically?
Yeah, we just never seem to be hit or hurt as bad as other countries. We may not do as well as other countries, but I guess maybe it's because we're such a small piece of that pie.
And
it just
conservative,
seems that
small c.
It just seems that we are, our highs aren't as high, relatively speaking, with the rest of the world, and our lows aren't. And I could be wrong on that, but it always seems that we're never in the dire straits, touch wood, that other places are in. Is that?
Well, it does seem like we haven't really had a huge recession in a long, long time.
Where other places have suffered a lot more than us.
Yeah. And it's more been like, I think you're right on that. We have not had a very deep recession.
Is that because of our regulations?
Part of it was, for the financial crisis, yes, our banking regulations were much stricter than the rest of the world. Mm-hmm. And even our banks, when you look at our banks, they're tiny compared to, Bank of America.
Interesting. Yeah. Kind of like us being the small guy.
Well,
don't you?
I'm okay with it. I'm happy enough.
Maybe boring to be a Canadian financial planner, though. I'm not so sure.
Well, no. Financial planning is dealing with people's personal finances. Okay, so we do both in the firm. We do the investment portfolio management. So we manage the portfolios. We do fixed income, high yield fixed income, and global equity, value equity.
Okay.
But we're dealing with private people, not institutions.
Okay.
So when you're dealing with a private person, you have to invest according to what their life is like. And that's what financial planning is.
Okay, so it's lifestyle.
It's stage of life. Where are you?
Okay.
Like some portfolio managers tend to invest a portfolio as if they are an institution, and they look very long term. They say, well, you should just handle the volatility because time and time has proven that volatility smooths out over a 30, 40-year period. Well, that is true. However, you're dealing with people. And people don't always have this smooth 40-year periods in their lives, right? People get married, they get divorced, they buy houses, they sell houses, they retire, they need to spend their money. Sometimes they end up having to be forced to spend money because they were laid off from their jobs. I mean, things happen in life, and so you can't invest a person's portfolio as if they're an institution. You have to invest it like they're a person. And financial planning, incorporating financial planning with the portfolio management actually is the best recipe to make sure that the person, in a sense, what you're doing is that portfolio managers understand that there are real people attached to the portfolios that we manage. And that is the key. Don't lose their money. People don't really, in my experience, people like to make money, but they don't necessarily expect to make 10, 15, 20, 25% every year.
They're
right?
reasonable.
They want a steady sort of growth, and what they don't want is to lose a giant pool of money. They've been through that already with the tech crisis. They've been through it with the financial crisis. They don't want that anymore. Especially people who are very close to retirement or are retired, because once you're retired, you know, you're spending your savings.
Yeah, it's no longer building.
You can't rebuild that if you make a mistake in their portfolios now.
Yeah, I know, that makes a lot of sense. Now I see why you're the queen of finance.
Yeah, and I'm sold all over again. So, okay, Susan, anything else? Any final words, or shall we just...
Did I deprogram you? A little bit?
Well,
okay.
Yeah, I am deprogrammed.
I think you confirmed more. He's really happy with you.
Yeah. Okay. All right, Susan, thanks. So there's the website, steinbergwealth.com. People can get in touch with you there.
Thank you so much. That was so informative.
Yeah.
Good.
So, thank you. And I guess that's it for the show.
Wow. Yeah.
All right.
Well, we covered a lot of deep stuff today. Really important stuff today.
Yeah. So thanks
deep.
everybody for tuning in. We'll see you next time right here on Liquid Lunch, national.com.